Most 401k investors are walking into a trap. The strategy that built wealth for decades is now destroying it. Your retirement plan could be doomed. This could be the most important video you watch about your retirement. Millions of retirees are heading toward a financial disaster. If you have a 401k, IRA, or you're following the old buy, hold, and pray strategy, this video could save your retirement. The stock market is changing fast. What worked for decades may now destroy your savings. This is the passive path. We believe in smart, practical strategies that protect and grow your wealth. Today, I'll show you how to avoid becoming the next victim of a failing system. Let's start with the 401k time bomb. Baby boomers were the first generation to depend heavily on 401ks and IRAs. The idea was simple: work for decades, save money in the stock market, then retire and live off the gains. It sounded great in theory, but theory isn't reality. Most 401k investors follow a set-and-forget approach. They pick a few mutual funds or ETFs, maybe a 60-40 portfolio. 60% stocks, 40% bonds. Then they hope the market keeps going up. That strategy worked in the past, but today's market is not the same. Markets are more volatile. Debt is higher, speculation is out of control, and financial advice on TV often leads investors into traps. Most people don't even know what's in their 401k. Ask around. Many can't tell you if they hold stocks, bonds, or anything else. They trust that buy and hold will work forever. But holding on during a crash can destroy decades of savings. History shows it clearly. The Nasdaq dropped over 80% during the 2000 tech crash. Many investors rode it all the way down. Some never recovered. The same happened in 2008. The same could happen again. If you think you can ride out the next crash, think again. Your retirement isn't a game. It's your future. You must understand the risks before it's too late. Next, let's expose the myth of buy, hold, and pray. Buy, hold, and pray sounds simple. It's what most retirement plans suggest. Buy a mix of stocks and bonds. Hold them no matter what. Pray the market keeps rising. This strategy is popular because it's easy. It requires no thinking, no adjustments, just trust the market. But easy doesn't mean smart. The 60-40 portfolio became famous because it balanced risk. In theory, stocks grow your wealth. Bonds protect you during downturns. That worked when bonds paid decent interest. When inflation was low, when markets were stable. Today, bonds often pay less than inflation, and stocks are more volatile than ever. The 60-40 portfolio no longer provides the safety people expect. Worse, many investors ignore the emotional side of investing. They believe they can handle losses. But when portfolios drop 50 to 80%, most people panic. They sell at the bottom, locking in their losses forever. This is not just theory. It has happened before. The tech bubble of 2000. The financial crisis of 2008. Investors do not rely on hope. They use strategies based on data, not emotion. First, they understand liquidity. When credit becomes scarce and banks stop lending, markets often decline. Most people never notice this until it's too late. Second, they track valuations. They avoid buying into overvalued markets. They know that when prices are too high, the risk of a crash increases. Third, they watch leverage. Today's market is full of risky products, double-leveraged ETFs, triple-leveraged ETFs, one-day options. These products magnify losses. Smart investors stay away from them. They also pay attention to technical analysis, not just price charts, but also trading volume and patterns. For example, when big investors start selling, volume spikes. This is often an early warning sign. The public rarely sees it until after the damage is done. Smart investors also control their emotions. They know that fear and greed lead to bad decisions. They have exit plans before they enter an investment. They accept small losses early to avoid bigger losses later. One rule they follow is clear. The first loss is the best loss. Waiting often leads to bigger, more painful losses. This approach is not complex, but it requires discipline and the courage to act when others are still hoping things will improve. Now, let's review the clear warning signs every investor should watch. A major warning sign is called the death cross. It's simple but powerful. When a stock's 50-day moving average crosses below its 200-day moving average, it forms a death cross. This signals that the upward trend is over. The market has likely entered a bear phase. Some investors dismiss this as too basic, but it often confirms what smart money already knows. The bull market has ended. Another key warning is disaster stocks. These are popular stocks that suddenly drop 20 to 25% or more in one day. Investors wake up to find their gains wiped out. Many freeze and hold the stock, hoping for a rebound. But the rebound rarely comes. Instead, the losses grow, down 30%, then 40, then 50 or more. Holding on turns investors into bag holders. This is how wealth is quietly destroyed. Remember, Wall Street needs someone to hold the losses. That someone is often the average investor. If you learn to spot the death cross and disaster stocks, you can avoid many traps. You can protect your portfolio from massive losses. Most investors miss these signs, but you won't. Next, let's discuss how to protect your portfolio starting today. If you want to protect your portfolio, you must take action. First, know exactly what you own. Many people can't even name the investments in their 401k or IRA. That's a mistake you can't afford. Second, reduce risky assets. If the market has already started falling, consider selling everything. Yes, everything. It's better to sit on cash than ride a sinking ship. Third, avoid emotional investing. Selling at a loss feels painful, but small losses prevent larger losses. The first loss is often the best loss. Fourth, diversify beyond stocks and bonds. Consider cash reserves, precious metals like gold and silver, other alternative assets that hold value during market downturns. Fifth, stop following mainstream financial advice. TV experts and financial entertainers are not responsible for your future. They rarely recommend selling because it hurts their business. You must think independently. Sixth, prepare for market cycles. Bear markets are part of investing, but they don't have to destroy your wealth. Smart investors reduce risk before the crash, not after. For those near retirement, be especially cautious. You may not have time to recover from a major loss. Protecting capital should be your top priority. If you think the worst is over, it may only just be starting. Now let's explore why financial education is your strongest defense. Financial education is not optional, it's essential. Most people spend years working for money, but they spend almost no time learning how to protect or grow it. That's why so many retirees face financial ruin. They trusted outdated strategies. They followed advice designed for a different time, and they ignored the warning signs. Reading is your first step toward changing this, but not all reading is equal. You must choose reliable sources. For example, newsletters that provide independent market analysis, publications that explain why markets move. Not just what happened yesterday, but even the best sources are just tools. You must think for yourself. Don't outsource responsibility for your financial future. No one will care about your money more than you. Passive investing sounds easy, but it can be deadly in a volatile market. You must stay informed. You must be willing to adjust your strategy. At the Passive Path, we believe in education first. Not hype, not fear. Just clear, practical insights that help you make better decisions. Knowledge isn't just power, it's survival. Knowledge isn't just power, it's survival. Let's talk about how the Passive Path approach can protect your wealth. At the Passive Path, we focus on smart, proactive strategies, not guesswork, not gambling. First, we teach you to identify market risks early, using tools like technical analysis, tracking liquidity trends, watching for leverage and speculation. Second, we promote flexibility. Your investment strategy should adapt to changing conditions. Blind loyalty to any asset class can be dangerous. Third, we believe in risk-aware diversification. This doesn't mean owning dozens of similar stocks. It means spreading your wealth across different asset types: cash, precious metals, conservative income-generating assets. Fourth, we prioritize capital preservation. In a bear market, protecting what you have is more important than chasing returns. Fifth, we encourage regular portfolio reviews. Know what you own. Understand why you own it. Be ready to make changes when needed. For example, let's say you're nearing retirement. Instead of a heavy stock portfolio, you might hold more cash and low-risk assets. You might use stop-loss orders to limit potential losses. You might avoid speculative investments entirely. These aren't radical ideas. They are practical steps that can protect your future. The Passive Path is about taking control, not waiting for someone else to fix your problems. The future belongs to those who prepare, not those who hope. Now, let's wrap up with the most important lessons you should take away today. Don't outsource responsibility for your retirement. No one will protect your money like you can. Ditch emotional investing. Your feelings are not a strategy. Learn to read the market. Or get advice that is truly independent and not conflicted. Accept that losses happen, but never let small losses turn into large ones. Keep a flexible plan. Be ready to change when the market changes. Always question popular opinion. The crowd is usually late to spot danger. Most important, invest in your own financial education. It's the best defense against uncertainty. Thank you for watching. If you found this valuable, like this video. Subscribe to the Passive Path for more clear, practical strategies. Comment below with your thoughts or questions. And share this video with someone you care about who needs to hear this. I wish you success and smart decisions on your financial journey. Feel free to watch other videos on this channel to keep learning and stay ahead. See you in the next video.